Good morning, ladies and gentlemen. Welcome to the IEA's media webinar to launch our World Energy Investment Report for 2020. Um, just before we start, we're joined this morning by Dr. Fatih Birol, our Executive Director, and Tim Gold, who runs one of the World Energy Outlook authors and runs our long-term Outlooks division for supply. We just on a scheduling note, I just wanted to point out before we start that we have a heavy publication season coming up. Two noteworthy reports coming up soon. One is the World Energy Outlook Special Report on Sustainable Recovery, which will be published on the 18th of June, and then the ETP Energy Technology Perspective Report, a special report on innovation on the 2nd of July. Please also, as you send us your questions, make sure to write your affiliation so that we know where you're writing from. And without further ado, I'll turn the floor to Dr. Birol. Thank you.
Thank you very much, Jet, and good morning, good afternoon, dear colleagues. I understand we have colleagues from US. I don't know if it's a good morning or good evening to them. Today we are releasing the 5th edition of our World Energy Investment Report. Every year we look at the global energy investments for oil, gas, coal, renewables, nuclear energy efficiency, all of the energy technologies, to see what was the budget of the global energy system. But this year, for the first time, we not only look at the last year, what happened, but also the 2020, because of the huge impact of COVID on the energy sector. My colleague, Tim Gould, who is the head of the World Energy Outlook work focusing on investment, and Mr. Mike Walden and their team look at the entire 2020, how the energy investment trends likely to evolve. But important here, we have the data of investments already made until mid-May. This concrete data there. After May, we made our estimates how the energy system could look like and what are the investment trends. Number one, we see the biggest fall in the history, about 20% in global energy investments, which is about 400 billion US dollar decline. This 400 billion US dollar decline and 20% is the largest in the history by far. And when I look at the impact, we see the impact everywhere, but oil and gas sector got a big hit. Our numbers show that the oil and gas sector investments will fall by a 1/3 this year. And this is even higher than what we have seen in the year 2014. But within the oil and gas sector, and in fact, in the entire energy system, the biggest hit is on shale oil in the United States. We expect that the investments in shale oil will decline by 50% with huge implications. Another area we are seeing the decline is the clean energy investments, which is renewables, efficiency, batteries, and all of them together. And the decline is less than the oil and gas. It's about 11%, but still significant decline compared to last year, which is, of course, much less than needed to reach our international climate targets, including Paris. Our numbers show that this year's clean energy investments need to more than double in order to reach the international climate targets. Last point I want to make on coal, another important area that we focused on. Our numbers until May of this year shows that the global coal fleet continues to grow. And the speed of green lights to new coal plant installations this year seems to be 2 times faster than last year, mainly coming from Asia, but notably China, as well as we see in Indonesia, Cambodia, Pakistan. Coal is accelerating in many parts of the Asian countries, and as such will have implications for all of us. To finish from my side, before giving the floor to Mr. Gould, who is the lead author of this report, that the findings of this report is troubling in many ways. But if I have to pick up one of them, for me, there is a great risk that the lockdown the world has experienced may lead to a lock-in of obsolete energy technologies, which could determine the energy patterns for years to come for our world. With this, I would like to turn to Mr. Gould for discussing some of the aspects of our report.
Thank you very much, Executive Director. I'd like to briefly explore some of those points and go through some of the key findings of the report, leaving I hope plenty of time for your questions. Of course, in an ordinary year, we'd be talking now about our findings on energy investment trends in 2019, but this is no ordinary year. So our investment team has shifted gear and is focusing on the extraordinary events of 2020. When companies put together their initial plans for this year, mostly in the second half of last year and into the early months of this year, their expectations and planning suggested a rise of around 2% in energy investment in 2020. This would have been the largest increase in spending since 2014. But COVID-19 has turned this into a record decline, as was mentioned by the Executive Director, almost 400 billion lower in our estimation, a fall of 20% year on year. Countries and regions with large domestic oil and gas industries have tended to have the largest declines, but everywhere has been affected. Where are these cuts in investment coming from? 2 key directions. First is just the practical disruption to investment activity caused by lockdowns, restrictions on the movement of goods and people, disruptions to supply chains as well. And all of that has contributed to project delays, pushing procurement schedules and completion times back, in many cases, into 2021. Second, and is the fact that companies with weakened balance sheets and more uncertainty over demand are cutting back on their planned capital expenditure. As a result of the crisis, there's simply much less money coming in to the energy sector this year because of lower consumption, lower prices, and notably in the electricity sector, a rise in non-payment. So here's a picture of what consumers typically spend every year on energy. You'll see that almost 90% of energy bills worldwide go to oil and electricity. However, this consumer spending on energy is plunging in 2020, and the collapse is very visible for oil. Already for oil, it's around $1 trillion. And what that means is that an interesting side effect of this is, for the first time, the amount spent by consumers on oil in 2020 is set to fall below the amount spent on electricity. That's affecting the energy-related revenues to governments, particularly severe impacts on many oil and gas or oil exporting countries that depend heavily on those sales for income. But of course, it's also affecting the cash flow to companies, and that's had a visible impact on the first quarter reporting that we've been monitoring very closely this year. And this is where we see the impacts. This is how that 400 billion breaks down across different parts of the energy sector. Most visible effects on oil and gas, and we'll come to that in a second, but no sector escapes. The cuts in upstream spending by oil and gas companies have been particularly stark, and they are visible across the board, from the majors to national oil companies and others. There have been a few areas, though, that have been particularly vulnerable. The executive director also already mentioned shale, but the funds available to many national oil companies for investment have also dried up. An example might be Sonatrach, which has seen its investment budget cut by some 50% this year. And companies providing services and supplies to the oil and gas sector have also been very hard hit. There's been multiple announcements of layoffs there. One thing to point out why this fall is different from the previous implications of the price fall in 2014 and 2015. Back then, the cuts in expenditure were absorbed in large part by cost savings. But the scope for further efficiencies is very limited now. And as one industry executive commented, we are now trying to squeeze water from a dry towel. So that what that means is that the cuts in spending that you see on the screen now are feeding through much more directly to cuts in activity. I mean, it's not just about the upstream either. The effects are being felt further down the value chain. There's been a real feast of famine in LNG, for example. Last year, 2019, was a record year for new final investment decisions all across the world, US, Mozambique, Russia, but announcements also from Qatar. In 2020, we expect those final investments decisions to fall to zero. What are the implications? It's important to understand that while the effects of today's crisis on demand and markets are immediate, the nature of energy investments is that decisions taken today, have visible impacts on balances only after a few years. So they come with a significant time lag. And as such, there's a possibility that this leads to future market imbalances and new energy price cycles or volatility. Just to illustrate this with an example of oil markets, the downward revision in investment this year, it doesn't have a huge impact on 2020 production as such, but by 2025, in our estimation, it takes 2 million barrels a day off supply. That's the effect from 1 year's reduction in upstream spending. But if investment were to stay at 2020 levels all the way through until 2025, this would reduce the previously expected level of supply by almost 9 million barrels a day. And that could lead to tighter markets if demand starts to move back towards pre-crisis levels. Now, onto the power sector, slightly less dramatic numbers. I mean, we've, as you might have seen from the earlier slide, around a 10% decline in overall investment, but still reasons for concern in a sector that's at the center of strategies for economic development and energy transitions. On the left-hand side of the screen, you see the comparison with 2015, but in fact, you need to go back 10 years to find a comparable level of investment to what we're seeing in 2020. It's useful to unpick some of these declines a bit. So if we, on the right-hand side of the screen now, you see are the changes in investment since 2015, broken down year by year and across different technologies. And it's immediately clear that what happened in 2020 was a continuation of pre-existing trends in some cases, and that's notable for coal. but it was also a trend break for renewables and a trend break for investment in gas-fired power. And investments in generation are only one part of the story. We need to pay close attention to investment in grids, which are the backbone of today's power systems and which become even more important in clean energy transitions. Worldwide spending on grids was declining in a number of countries already prior to 2020, and it falls again in this year by 9% in our view. And there are some warning signs here. Tomorrow's power systems have to remain reliable, even as they're transformed by the rise of clean energy technologies. The executive director already mentioned coal, and just to put a visual to some of his remarks, this is a slightly different metric. We're not looking at inflows of capital into the system here. We're looking at approvals of coal power capacity. So the vertical axis is gigawatts of capacity. 2019, these fell for the fourth year in a row, down to the lowest level since 1980. But as the executive director said, pay attention to the emerging picture for 2020. Already in the first 3 months of the year, well over 10 gigawatts of capacity got the green light. So these approvals are running in 2020 at more than twice the pace seen last year. A word on how these investment trends stack up against the urgent challenge to bring down global emissions. So these are all of the clean energy areas. So renewable power, renewable transport and heat, nuclear, energy efficiency, battery storage, carbon capture, and so on. You might have expected to see this increase over time, given that we're covering the time period since the conclusion of the Paris Agreement. But taken together, these elements have remained stable at around $600 billion per year. In fact, the picture is slightly better than the headline numbers would suggest, just because the cost declines in key renewable technologies such as solar PV and wind means that every dollar spent in those areas is working harder. It gets more capacity for each dollar spent. The share of that clean energy spending in the total investment is set to rise this year. But that's only because other parts of the system, fossil fuels, have seen investment hit harder. But as the executive director said, in absolute terms, that's well short of what would be required to put us on a more sustainable pathway. Investment in these areas would need to more than double over the next 10 years to put the world on track to meet international sustainability goals. Finally, a word on pathways out of the investment slump and the crucial role of governments. The picture that we've described today brings a number of risks, many of which could slow down the structural transformation of the energy sector. So energy companies emerging from the crisis with weakened balance sheets could rein in investment plans as a result. Corporates inside and outside the energy sector could hesitate or downside that power purchase agreement that they're considering for renewable electricity, or limit their R&D in improved technologies. It might prove just a bit more difficult for that entrepreneur or that startup with the promising new technology idea to find venture capital. And households might think twice before replacing that old inefficient water boiler, or before they decide to invest in rooftop solar or in an EV, especially if and when fuel prices remain low. So in all of these areas, the steps that governments take will be crucial to mitigate these risks. That's why the IEA is putting such a high priority on integrating energy and sustainability into recovery strategies. But starting points vary widely across the world. The fiscal space available to governments varies widely, but there's also the element that we highlight on this slide, which is that divergence in the roles of state versus private actors in energy. So we've done some detailed analysis of this in the report this year. State-owned enterprises account for well over half of energy investment in developing economies, but less than 10% in advanced economies. The situation varies depending which sector you're talking about, Notable that in renewables across the world, the dominant role is taken by private actors. But here too, many renewable projects rely on incentives set by governments and on sales to state-owned entities. So the pathways out of this crisis, especially in the developing world, depend not only on governments, but also on the financial sustainability and strategic choices of these state-owned enterprises. That's where I would like to leave it. We have some conclusions, but I would just leave those on the screen, and I would then pass back the floor to Jad Mouad and look forward to your questions.
Thank you very much, Tim. Okay, so this concludes the presentation part of the webinar. We now would like to take your questions. We will give you about 2 minutes to type in your questions while we collate them. So please refer to the question box on the Zoom app and send us your questions. We'll just take a 2-minute break while we collect all the questions. Thank you. Okay, we'll take questions as they come in. We have 3 questions for now, so I'll read out the 3 questions and then pass them on. So the first one from Tom Brown from ICIS, who asks, prior to this, a lot of oil majors were pivoting to deriving a larger share of their income from higher margin sectors such as petchems. Does the drop in energy investment extend to the petchem sector? And are sharp falls in energy company spending plans likely to impact on that shift? So question on petchem, probably to Tim. A second question from James Varley, what is driving the expansion of coal in China? And third, in Asia, sorry, third question from Junior Isles. How do you see investment responding in the clean energy sector next year and in the coming few years? And this is a question also, a similar question we have on what are the consequences of these trends for climate. Probably this one is for you, Dr. Birol. Tim, over to you, please.
So thanks very much for the question. I'll take the first one on petrochemicals. And indeed, it's true that uncertainty over the trajectory of demand and prices and the shape of an eventual recovery from the economic slowdown are going to weigh on investment decisions in the petrochemical sector. A little bit of context here also on what's been happening in recent years, because the pace of investment in petrochemical facilities has accelerated quite dramatically in recent years, and it's actually moved well ahead of the rate of demand growth. In 2019, for example, the annual increase in global ethylene production capacity was 60% higher than the level of demand growth. And that's had impacts for ethylene prices across the board and indeed for earnings. And so this mismatch between near-term capacity expansion and near-term demand for key petrochemical outputs could be exacerbated by the effects of the pandemic. So in 2020, we're expecting another very large expansion in ethylene capacity around the world, if all projects go ahead as scheduled. So, you know, there are some near-term clouds on the horizon, but as we've emphasized in previous IEA analysis, you know, the longer-term outlook for products of the petrochemical industry is still very, very robust. And the second question on what's driving the expansion of coal in Asia. Well, I think the first thing to say is that, you know, in a longer context, so if you take a 5-year horizon, I mean, coal is expanding much more slowly than it was. But as Dr. Birol mentioned, the overall size of the coal fleet continues to expand. And we shouldn't forget that there's quite a large pipeline of new coal plants under construction. So in our estimation, around 130 gigawatts of coal around the world, but predominantly in Asia, has had its final investment decision taken and is working its way through to becoming operational. So even though there's been an increase in retirements for largely older coal capacity in Europe, in parts of North America, and in other parts of the world, that is still outweighed by the expansion in largely in Asia. And this is not just about China. I mean, if we look at those final investment decisions that have been taken this year, the majority are in China, but there's also in Southeast Asia, Pakistan, and in some other countries too. It's really being driven by the fact that these remain, for many countries, the sort of default path for capacity expansion. And in some countries, it's because the construction costs remain relatively cheap. Coal remains relatively cheap. So even with the expansion or even with cost reductions in renewable technologies, there is still momentum behind some of these final investment decisions.
And let me take the third question about the clean energy sector investments and the challenge of climate change from Junior Isles. Now, we had the Paris Agreement, and many countries said that they are going to reduce their emissions, and the clean energy, renewable energies, efficiency, and the other clean energy sources are the key drivers of a future that could bring us to reach Paris goals. But since Paris, the amount of money the world spent on clean energy basically remained stable, 600 billion US dollar. 2015, 16, 17, 18, and 19. And this year, we see a steep decline, about 10%. Now, whether or not, as our colleague asked here, there will be an increase on the investment in the clean energy will be critically hinging on the recovery packages that the governments are now designing around the world. We are working with many governments to give them suggestions, right energy policies to include in this recovery packages so that we have a clean energy transition accelerating in the future. But without, if everything is left to the markets, we may have difficulties to see that the clean energy investments will double, as you ask. One point on coal, to add my colleague, Mr. Gould, learning from history. So this year, we see global emissions increase record levels. Our numbers we have presented 3 weeks ago show that the emission decline this year globally erased the increase of emissions in the world in the last 10 years. Big decline. Now, the question is, what will happen next year or the year after? But when we look at the past, just to bring it to the attention of our colleagues, in the year 2009, global emissions after the financial crisis declined 0.4 gigaton. But the 2010, next year, with the recovery of the global economy, we have seen the biggest increase in global CO2 emissions, 1.7 gigaton. And this is mainly driven by coal and coal in Asia. Just wanted to make that point here. Perhaps we have some several other questions.
Okay, so we have a couple more questions, which I will read out. The first one from Cian Crampsey. Question is, with constrained government budgets, to what extent are renewable energy support schemes at risk? And how could this affect project investment in the next 3 to 5 years? I'll direct this question to Mike Waldron, who is one of the authors of the report. Second question from our colleague from Norway, Terry Erikstad. Why are there so many new coal plants being accepted this year? Just a coincidence or because of policy? Perhaps, Tim, you can take that question um, first. Thanks.
So just to follow up on the coal plant question, indeed, it feels counterintuitive that we see this spike in new coal plants approved. There are, of course, as everyone is aware, very strong social environmental pressures. There's some financing pressures. And also, we need to remember that the utilization of existing coal plants in many parts of the world has been squeezed by the drop in demand this year. So it does feel counterintuitive. And of course, we need to remember that these projects don't come along overnight. They have a long sort of gestation period of planning and so on. So there is a degree of coincidence here. But there's also, I think, some policy elements to it. People who follow China should recall that decisions on approval of new capacity were given to the provinces a few years ago. A couple of years after that, there was this sort of traffic light system, a coal alert system, where provinces were graded red to green, depending on their ability to approve new. There were certain criteria which govern their ability to approve new investments. But it's true that now most provinces are given that green status, so that they are able to take these decisions. And then perhaps, Mike, you would take the other question.
Yes, thank you very much for the question. I think first I'll just unpack a little the renewable investment trends that we see in 2020. So the 10% decline in renewables is very much driven by solar PV and onshore wind, whereas longer lead time technologies such as offshore wind and hydropower with more developed longer term project pipelines, these are actually quite stable, or at least somewhat growing in investment in 2020. So the prospects in those technologies are still rather good. In terms of the prospects for support schemes and how this looks in the future for renewables, I would remind you that we've said in the investment report for several years now that over 95% of power sector investments are driven by some sort of government policies or contracts that helps to mitigate the revenue risk available to projects. In renewables, this is almost 100%. And what we've seen in renewables is this shift in policies towards competitive auctions, which have made renewables more affordable over time. So at the same time, there are constraints on government budgets. The costs of deploying renewables have come down for many years. The situation of how this evolves is going to differ between advanced economies and developing economies. So in advanced economies, what we've seen so far is policy schemes have been somewhat accommodating to the current disruptions. There have been some announcements of delays in auctions, but there's also been some announcements or auctions held or announcements of accommodating project timelines. In some places, there was already before the crisis visibility that subsidies or incentives were going to be phased down. This is an example of the US where tax credits were being phased out over time. So renewables in these countries in competitive markets were already facing the prospect of increased market risk, perhaps more financing with equity, perhaps upside risk to the cost of capital. This is why things like corporate PPAs, which have sprung up in the US and Europe, have become more important. But at the same time, some governments in advanced economies recognizing the importance of renewables have announced measures to give long-term visibility. So the European Union is announcing this 15 gigawatts of new renewable auctions in the next few years, which we've seen ahead of the announcement from the Commission. In developing countries, the situation is a bit different. Here, the development of renewables very much depends upon the creditworthiness of state-owned utilities and their willingness to purchase power. Changes in financial flows, in currency, and sovereign risks have put a lot of, as well as the demand situation, has put a lot of pressure on these utilities, and the risks are rising. For Brazil and Mexico, they've taken their auctions for renewables off the plate. India is still continued, but with problems related to the distribution companies. So it really depends on the ability to shore up the finances of the utilities in emerging economies, which will determine the trajectory for renewables. Amid all of this, the grids are very important. So governments around the world need to continue to support of investment in the grid. There's been good visibility on governments doing this, but the downfall in 2020 is certainly a risk to renewables going forward. Putting it all together, and we said this in our renewables market report the IEA did last week, it still expects a rebound in renewables over time, but with some of the risks that I've laid out in the answer to your question.
Thank you very much, Mike. So we have 2 more questions which we'll take, and then we will wrap up the session for today. The first question from Julien Matonier from Energy Intelligence on given the huge addition in global refining capacity, do you expect more pain for refiners going forward? I'll send that question over to Tim first. And then the second question, or final one, from Arushi Kundal. How much time will it take to come out of this fall in clean energy investment, and which sector would attract most investments post-COVID? This one probably for you, Fatih. Thank you.
So thank you very much for the question on refining. And the answer feels a little bit similar to the answer that I gave before on petrochemicals, because indeed there's been these huge additions in global refining capacity, which have run well ahead of near-term increase in demand for oil products. I mean, the difference there is, well, one of the differences there is that contrast between oil products and petrochemical products. I mean, there is, you know, the much greater uncertainty over the long-term outlook there, and that, I think, speaks to the next point, which is the amount of the sort of pain for the refining sector may experience going forward. Refiners are coming under significant pressure here. The plunge in demand has been particularly tough. So many refiners, the majors, independents, are taking a hard look at their planned investments and divestments. They may reevaluate their existing portfolios, and that could lead indeed to a new wave of closures in some refineries, for some refineries at the higher end of the cost curve. And that would indeed accelerate this restructuring that's underway in the global refining industry towards regions that either benefit from cheaper feedstocks, so the Middle East is a very good example there, or close to still growing demand regions such as those in developing countries in Asia. The implications of that for the segmentation of refining or for trade flows is an area that we do look at. Overall, the refining sector is still set to remain more diversified compared with other sectors. It's the export part that would be most affected. So it's certainly one for us to watch as we go forward, and I'm sure our colleagues in the oil markets division will be analyzing that very closely.
Thank you, Mr. Gould. Now, let me take the last question. How much time will it take to come out this fall in clean energy investment? First of all, before giving a factual answer, let me tell you, I hope it will not take too long to come back, because we are risking locking in our energy system in an obsolete technology fleet. So this is a big risk coming through. And the second point, if we leave everything to the markets, if there are no government policies put in place in order to help the clean energy investments to rebound strongly, we will not be able to see clean energy investments coming through in a strong way. When it comes to renewables, declining cost of renewable energies and them becoming more competitive alone will not shelter them from the effects of COVID crisis. So therefore, government policies will be critical in terms of renewables. auctions, long-term contracts will be still very important, but also it is not only renewables, solar and wind. We are not talking about the clean electricity transitions. We are talking about the clean energy transitions. So therefore, investment in the batteries, hydrogen, carbon capture and storage will be of critical importance. And we hope that the recovery packages, many of them once in a generation and scale, will include these right energy policies which help the governments to create jobs, boost the economy, and prepare us for a much cleaner, much more resilient and modern energy sector after the crisis. Thank you.
Thank you very much, Dr. Birol. Thank you very much, Tim and Mike. So this concludes our webinar for the investment report. Just a reminder that you can find all the findings on our website. The report is entirely online. If you have further questions, please email us at press@iea.org. Our media relations officer, Marve, will be very happy to put you in touch with our colleagues, Mike, Tim, and other team members who've produced the reports. And again, on a scheduling note, we have our upcoming World Energy Outlook special report on sustainable recovery, which will be published on June 18, one of many reports that are coming out through the summer. Thank you very much for your attention.